Good morning. This is Axel Merk, Merk Investments with our risk off briefing today. Um, the moment the markets are turning, it seems the media is jumping on all the bad news. And so that's yet again showing why I think investors need to have their own process because otherwise they're just going to be chasing the tail of the market. Anyways, S&P futures down 75 at this stage. The Dow is down 795. Gold spot is up $1.30 right now at 1739. The gold futures look up, they are up at 28 bucks at 1748. The reason there's this discrepancy is because there are different closing times. Bonds are stronger. 10 years up 16 ticks, say 30 years up a full point and 28 ticks. The 3-month T-bills are at 17 basis points, 3-month LIBOR at 31. Effective Fed funds rate is at 7 basis points. The VIX index is at 3091, and the VIX curve is negatively sloped, and that's a fancy way of saying is that this is a panic light. It's not panic exactly, but that the present is considered more fearful, that people are more confident about the future. Obviously, it always depends on how one looks at these things. And when you look at volatility, when there are known risk events, if say election coming up, then there is the uncertainty. The known uncertainty will be priced into derivative markets and so forth. But in any case, yeah, VIX curve is negatively sloped right now. In globally, markets are down. Eurostoxx 50 is down 2.9%. Kakao is down a little over 3%, for example. The Swiss market is only down 1.8%. The Nikkei was down 2.8%. Hong Kong was down 2.3%. And I've been quoting the CSI 300 in China, that's down 1.1%. Australia was down 3% as well. Um, and in the currency market, the quote unquote safe haven currencies, the yen is up, are stronger. The yen is up 29 basis points, and so is the Swiss franc. And on the tail end in the G10 and the major currencies is the Norwegian kroner, down almost 1.5%. And then the next one up from that is Australian dollar, also down. And since I mentioned Norway, let me mention crude is down 7.4% for West Texas at 36.68, and similar 6.5% down for Brent at $39. And so Powell is being quote unquote blamed for this risk off environment. We did have the Fed meeting yesterday. Powell doesn't dictate the economy; he just gives his own 2 cents, and he's just cooking with salt himself. And so he suggests that we're not going to have a V-shaped recovery. I don't think he used those words, but he said that it may take years for millions to get a job back, saying that what he's concerned about is structural changes in the economy, where people have to change industries, just kind of on the backdrop of the K-shaped economy that the Financial Times journalist wrote about, that for many of us who are sitting at a computer, this crisis has been an inconvenience, but if you cannot work from home, this is far worse. And so with that, let me just mention here that the jobless claims, initial claims were 1.5 million, and the prior was 1.5 million, yes, and that was at around as expected. Continuing claims were worse than expected. They were expecting 20 million, and it came in 20.9 million. So that's a huge miss here on the continuing claims numbers, and so that may well be part of the reason um, why the markets are not happy. Producer prices came out today. Um, minor. Well, let's just talk about here inflation. Powell said he is not even thinking about inflation. And if you follow me on Twitter, you've seen a little rant that I had on that. It's a core part of the job description of anybody at the Fed to be thinking about inflation. And so for him to say that he's not even thinking about inflation is a pretty strong statement. Now, there's a reason for that, of course. The reason is that inflation is currently not the concern, and the Fed is always worried about the concern of the day rather than the concern of tomorrow. And so I get that. Um, but in my view, one should always look at the different scenarios. And the key thing that's different is that the stimuli we had after the financial crisis, they first weren't very effective, and then they weren't particularly inflationary. When you give a corporate tax cut, yes, I was concerned about the inflationary fallout in the long run. And if you follow our research charts, that we show that how many people can you draw from the sidelines? You remember we were at record low unemployment, and when you exhaust the pool of available labor, and I was critical that Powell seemed to shrug that risk off. Because at some point you're going to hit that barrier where it's going to be a problem. We weren't there. I have my own views as to when we would hit it, just speculating, but at least one should think about those issues, I would think. And the Powell now is that, oh, we'll go to where we were and then we can push further. And by the way, we'll keep rates at zero and printing a ton of money until then. At least will be, the Fed has pretty much promised that they'll be printing about 80 billion a month. That's a rate of about $1 trillion a year until at least the end of 2022. So that's quite a calendar-based commitment. And just like to remind people, we do have an election coming up. And while the normal scenario is that you have some sort of gridlock in Congress, it is not impossible to have both the House, the Senate, and the presidency controlled by the same party. And if that is the case, if that were the case, that's historically, and it doesn't matter whether it's Republican or Democrat, and in this case, the odds of that happening is more on the side of the Democrats. But if that were the case, that historically means more government spending, substantially more. Now, people might shrug it off. Hey, we spent trillions now. What does it matter? Well, what makes a difference is that the sort of spending programs that have happened make it to people actually use the cash. The corporate tax cuts doesn't make it to consumers that spend it. It may help the overall economy, it may increase employment, and that might be good for everybody, but it is not as inflationary as giving a check to the consumer who desperately needs the money. And it's a political decision, of course, how you allocate those resources. But if you have all the power in one party, the odds are that you would have more of these policies. And even with a gridlock, it appears both Democrats and Republicans are favoring infrastructure projects where you could get help to many of those people who are desperately looking for a job. And if that is the case, that could be far more inflationary than the sort of policies we've had over the last decade. And so I'm not suggesting inflation is going to break out tomorrow, but I am concerned when the Fed is completely shrugging this off. As I'm looking here, the markets are moving a little bit more. Notably, the currency markets are moving a little bit more. I mentioned that the yen was up a tad. Well, now that the yen is up 43 basis points as I talk, and so the yen was very, very weak last week. And then yesterday was strong, but we're still at 106.70 here. That hasn't really had a rally. That's not amazing. If we really have a severe risk-off environment, you would expect, and I'm not here giving investment advice or making forecasts. And with that, let me just give my wonderful disclaimer here, so I get this out of the way. It is just if these markets had more conviction, so to speak, on the up or downside, you would see much stronger views. By the way, the South African rand here is the weakest on my board, down over. It's that particular line I had last time trouble reading with as well. I believe that is a 2.7% here. That is down. Let me just pull up another chart here while I talk with you. And so back to the Fed, the other thing, of course, that is on people's minds is the yield curve control, and it is something that's being discussed. And as as I pointed out, yield curve control is about introducing red lines, and introducing red lines, in my view, is a bad idea because it can lead to bad things here in the medium term. Anyway, it's difficult to chat and pull up data here at the same time, but I just tried that. In any case, other than that, let's see what else I can tell you. The energy sector is for the most part down. I say for the most part because natural gas is actually up. Yeah, and the one thing that happened yesterday, of course, during Powell's speech, is gold benefited substantially from the sort of thing that happened, and that's not surprising because it is when you promise to keep rates very low. Well, guess what? You don't get compensated for holding cash, and there are a lot of people look at kind of short-term inflation. When I look at the price of gold, I like to look at the 10-year yields, 10-year real rates. I think the correlation there is better. And the 10-year yield is at 67 basis points right now. And we have the discussions in the offices. Are we all going to meet where Japan is? Everybody down at zero throughout the yield curve. And it may well be the case. It's just incredible because it is not exactly supporting efficient capital allocation in my book when money is free forever, and that's an odd sort of world that we live in. Alrighty, goody. I'll wrap it up here. Be safe out there and be prudent in the markets. Take care. Bye bye.